The fastest way to put a little wind in your sails as far as your longs are to buy when there are other buyers. Long time ago, before all this internet stuff came about, we had like level two and you had tape reading. That's pretty much how you did it. As far as stocks were concerned with the floor, you have open interest, volume, and certainly you had the level of noise coming in off the crowd as the prices moved into key inflection points. So my own style of knowing when there's buyers, but when I buy when there are other buyers, comes from understanding pretty much how the floor works. Now, granted, there's not much of a floor environment. I suppose you could look at CVD, and this and that. I don't. I don't look at any of that. I try to keep it as simple as possible. I don't have any order flow metrics. I really just still kind of read the tape and look how the price performs at key levels. And I keep it simple. Why? Well, because again, I don't need the level of security that many of you might need to make me feel good about what I'm doing. I don't mind the risk that goes with it emotionally. I don't mind the financial risk. I have really, really good instincts. So when I think about how things used to work, when you're coming up to like a multi-period high, for example, you knew on the floor that the folks who are trying to fade the move aren't going to stay in a rallying market for any length of time, right? Especially if they're scalping. They're going to place their protective stops above the market. We also know that the longer the time frame, the less random the data are, and there are many breakout system traders who are going to buy. And I used to talk to Bill Dunn about this. Using N as a variable, you can calculate how many different systems are going to come into play by looking at the number of days, knowing the N day breakout. So I kind of learned reading the tape, learning how the floor worked, and then learning and marrying that up with the breakout traders who are putting resting buy stops in above the market, knowing that they wanted to catch that momentum and buy the breakout, so to speak, to catch the move to the upside. And I had observed that enough to see that that was, I don't know that it was an edge, but it seemed to be a good entry point because the order flow that would come in behind was oftentimes, I don't want to say it was gargantuan, but the shorts don't want to be in rising markets. And the day traders don't want to sit in there because by definition, they're trying to make money on the day. So they're not going to sit in shorts that way either. And the breakout traders aren't really looking at reading tape or otherwise too. They're just saying, okay, if the price here is achieved at this price point, then buy me this amount of inventory based on all these other metrics and how to, position size. And so what I would do after the fact is go back and look at time and sales, right? After the fact, while I'm already in the trade. I'm taking it home with me. Again, it might not be your style. You might not have the stomach lining for that. And I would see what kind of orders went through at those price points. Not all the time, but sometimes you'd see that they were bigger prints around those numbers. And so for me, I knew in many ways that those might not necessarily be aggregated retail orders because in the day, a lot of those smaller orders were getting done electronically without human intervention, even back then. So I kind of surmise like there could be evidence that there's institutional activity, as you've heard me say. I'm not the only one to say it, that institutions leave footprints. So then I'd be like, okay, well, those people typically want to defend their positions then, right? Because they're just getting started, right? If I'm looking at a hedge fund or a mutual fund, ETNs and ETFs didn't exist. You had closed-ended funds at the time, open-ended funds, mutual funds, and hedge funds. So the environment was very different. They have so much money that buying, 10,000 shares of a stock, again, is just the beginning for them. You see? So I could infer that I don't know who it might be because it's all done anonymously, but that there's more buying behind it. And two, if there is that little kind of cup and handle thing, there's a moves a breakout, then there's a bit of a pullback, that oftentimes becomes a second entry for those folks, not the first one. So again, I got to witness other people's behavior for those people who were buying long and say, okay, what's going on here? How can I play, detective and figure this out? And so from that, I developed my own style, just like I advocate for you to do. So what I found over time, not any one particular trade, but long stretches of time for both futures and for stocks, that institutions would step up and support those price points. Being a smaller trader, right? The water's cold. I needed to make sure that there were those other players there so that I wouldn't get bullied. Think of them as like big brothers. Because if they liked the price at a certain level for their first risk unit and the market pulled back as it does oftentimes have a bit of a natural reaction where there's a quick little blow off for the scalpers and the day traders, oftentimes you'd see institutions coming in and buying their second risk unit at a very similar price. So I was like, well, that's wind in my sail, because now I know that those folks who have much greater account sizes who could knock my lights out in the flick of a switch are going to support the prices there. So that gave me a little buoyancy in my position, right? Not all the time, but a lot of the time. So that's what I mean when I say I want to buy when there's other buyers. I want to take advantage. Now it's not a different. Now it's it's a little bit different because I have all the money in the world. But when I was starting out, you remember things were trading at eighths. Big swings would hurt me. The commissions were also sizable. It would cost me 50 cents to a dollar, to sometimes round turn in a trade, just as break even. I wrote about some of these things in the Inner Voice of Trading. I give the audiobook version away. If you're still watching, the link is in the description. You could download the audiobook version for free. It has 4.5 out of 5 stars on Amazon, the hardcover anyway. And so this is what I mean by trial and error. I didn't know what I was doing, but I had to try and see what I could garner from the data so that I could make better decisions going forward. That was always, like people say, 1% better every day. That's really all I ever tried to do. I knew that I wasn't going to, become Paul Tudor Jones in a week. That's just not practical. So through your own trial and error, you might very well find that there are no buyers in pullbacks. That might be an indication that there's going to be further weakness. It also helped me define why a rule that I have that I don't trade, and that is, well, did I say that right? I don't trade inside of channels. I either want to be long above resistance or certainly short or not long below support. I don't really do anything when markets are, channeling sideways. I don't find it I don't like scalping in them. It's not enough money for me to care. And, again, because I'm not in front of the screen. So while everyone's trying to short at resistance, buy at support, and maybe do that several times a day, I'm going to miss that whole trade deliberately on my own volition and wait for the market to choose who's actually in control for a much more pronounced move, which for me would happen beyond resistance. You see what I'm saying? You might feel differently. More power to you. I'm not here to, again, call your girlfriend ugly. I'm just saying that that's what I observed in the environment that I grew up in, right? It was very different 36 years ago. So you can't judge apples. It's apples and oranges compared to, when I started. And so my experiences and the environment I grew up in really shaped me, and it shaped my trading the same way, you're going through all of that right now. So, in the end, you have to make a suppose what happens, because you're never going to really know for sure. You have to watch this. I went back and I dissected and did a post-mortem on every one of my trades without judgment, because I knew I didn't know shit. So there's no sense in beating somebody up if they don't know what they're doing. So I was looking at the data. And what decisions could I have made differently, given what I can see after the fact? Is there evidence, right, of something raising its hand before I put the trade on that might give me a moment of pause? You know what I mean? Like, for example, if you buy breakouts, do you actually buy one tick above the previous high, or do you give it more room to take into account that there could be noise around what you think that signal might be? That's going to come from trial and error. Backtesting can help for sure. And you can test to see what that does to profitability. For my style of trading, believe it or not, giving another 25 cents on a stock and even sometimes, several ticks on futures didn't really hurt my profitability all that much. Now, if you're scalping, it might mean all the world. But for me, that data, for my style of trading, it's too random to care. So this is what I mean by keeping a diary, going back and looking at your trades and not judging whether you made money or not. That's not the point. You want to go back and say, well, what did I know at the time that I made my decision, and what could I learn from what the result of the trade was by looking at the data, right? We talked about that. If you look at Martin Chronicle and search for Annie Duke, she and I had a conversation about resulting. You do a lot of reckless behavior, but the trade turns out to be a winner, and all of a sudden you're like, man, that's the way I'm going to go. So you got rewarded for doing bad stuff. Sometimes you do all the right things, but you still lose, right? That happens in sports. Coach, you put Martin in there, to steal. He got thrown out, ended the game. You don't ever want to get thrown out at third base. Well, Martin's been, he's stolen third 90% of the time, success rate. So we figured, if there was somebody that was going to steal the bag and get away with it, it would be Martin. This time we got thrown out. That's the way that it goes. Well, knowing that, would you do anything differently? No, because the probability is that when he steals, he steals 90% of the time. So we're going to play the odds. It didn't work out this time. But if we do this 100 times a season, he's going to steal 90 bags. So I'm going to be the first 50-90 guy in the MLB in my late 50s. Get ready for me, Acuna. So at the end of the day, that's how you have to think. You have to think probabilistically. Like, just because something doesn't work once, it might work out many, many, many times. And that comes from trial and error, and that's how I developed understanding where there are other buyers. You might not be able to tell in the heat of the moment, but you can see after the fact. Look at the size of the prints, because they'll be there. If you have success with some of these other things, I'm too old and too cranky to care about CVD. If it works for you, knock yourself out. But I'm not going to, look at that at this point. I feel comfortable with what I'm doing, and it works for me, and I still have great success with it. But again, at the end of the day, it still doesn't mean when you buy with other buyers that it's all the time going to work. It still could come back in your face. There could be a piece of news that comes out. There could be something about the economy, about inflation, that sends both the instrument you're trading as well as the overall market against you. That's why in the short run, you can't really beat yourself up over it, because there's a lot of unknowns, things that you never could know. You see what I'm saying? But that's the kind of stuff that I put on in my brain, right? And then I go back and I back test for the things that I can. And I see that, there are very, very few things that you can trust other than the price in many ways. Even if you're not a momentum trader, open interest, that too is sometimes unreliable. Take a look at the cocoa market right now. This is, here we are at the end of March in 2024, depending on when you might, be watching this video. And the cocoa market's going berserk because there's a lot of things going on with the supply side in Western Africa, where we garner 60+% of the world's cocoa. And the fundamental side of the story is basically simple. These aren't beefsteak tomatoes where you can plant a new tomato plant every year and get a robust harvest. If something's wrong in the cocoa crop and you plant new cocoa trees, it's going to be 6 or 7 years before it's going to yield anything material, right? So my hunch is that these prices aren't going away anytime soon. If you look at the May contract, which is the front month for cocoa right now, you'll see that the price has gone from 6,500 to 10,000. All the while, open interest has gone down. And we still have 5-6 weeks till, at least another month until, expiration. Why is that? Well, an outlier event. The exchange has seen that the ATR and the volatility has gone from about 60, 70-ish to almost 400. And when that volatility kicks in like that, in order to keep and maintain the integrity of the marketplace, the exchange raises the margin rates. They have a span calculator that they use, and they are the sole entities that can increase. Well, the broker-dealer FCMs can increase margins, but the exchange, it sets the base level. They can't make it below the base level. So what ended up happening is the margin, went up, whatever it is, 15,000 a contract. And so that's knocked out many of the smaller, traders. who don't have enough money, to do that, because it might take up too much cash or might cause them to have fear. So you saw a decrease in open interest simply because certain traders got knocked out. Whereas if you look at the July, open interest has gone pretty much sideways. Normally, when you would see open interest going down as prices increase, you could infer that shorts recovering into the higher prices, right? Open interest is going down. So what you would see when you're in a trend, open interest and price moving not necessarily in lockstep, but both increasing, inferring that new longs are entering the market. Anyway, that gets a little too detailed for what we talk about here, which is largely trader mindset. It's just good to know that when you're buying, that you're not alone in the trade. As your trading gets bigger and bigger and your position sizes get bigger, you also want to learn to live with very sloppy entries and lots of slippage and skid. The last thing you want to do is put an order down for 50 of the large gold contracts and the COMEX and get everything filled at one price. That could tell you that there's a lot of people who were looking to move and get out of their inventory and ready, willing, and able to sell it to someone like yourself. If you like this video, check out this one here.